Good morning. It's my real pleasure to welcome you to this morning's event on monetary policy and the everything bubble. And it's my particular pleasure to welcome our distinguished panel of experts. I can't think of a better group of economists to shed some light on this very important and timely topic. In the order in which they'll speak, they are Tobias Adrian, who's the financial counselor and director of the Monetary and Capital Markets Department of the International Monetary Fund. He'll be followed by Joe Gagnon, who is a senior fellow at the Peterson Institute of International Economics, and who was formerly a senior official at the Federal Reserve Board. Joe will be followed by Bill White, who's currently a senior fellow at the C.D. Howe Institute in Toronto, and he was formerly a senior official at the OECD and the Bank for International Settlements. And the event will be moderated by my former colleague and good friend, Alex Pollock, who is now a distinguished senior fellow at the Mises Institute. And Alex formerly served as the principal deputy director of the Office of Financial Research at the US Treasury. By way of introduction, I might say that since our last event on this topic in March, there have been a number of very important developments that make it all the more timely that we take another look at the issue of whether or not there's a bubble. Allow me to mention four of these factors that have occurred since our last event. First, since March this year, the Federal Reserve and the European Central Bank have continued their aggressive bond buying programs that have added substantially to global liquidity. Over the past 6 months, they have increased the size of their combined balance sheet by around $2 trillion, even at a time that there has been increased froth in the financial markets. As a result, the combined size of their balance sheets now totals more than $18 trillion. It's only now that the Fed is indicating that it plans to start tapering its bond buying program later this month with a view to ending the program by the middle of next year. Until the Fed ends its tapering, the Fed's monetary policy will remain highly expansive. The second point I'd note is the excesses in the asset and credit markets that we noted in our last event have only got more pronounced. US housing prices are now rising by almost 20%, taking their level in inflation-adjusted terms to well above their pre-2006 peak. At the same time, US equity valuations are now at lofty levels experienced only once before in the last 100 years. Interest rate spreads on high-yield bonds have reached record lows, and the prices of exotic assets like Bitcoin have reached the stratosphere. The third point I'd note is that excessively loose monetary and fiscal policies are now leading to inflationary pressures that look far from transitory, as this week's 6.2% consumer price inflation number reminded us. Whereas at the start of the year, the Fed anticipated that its favorite inflation measure, the personal consumer expenditure deflator, would increase by 1.8% in 2021, the Fed is now acknowledging that inflation could approach 4%. That would be its fastest pace of increase in the past 30 years. All of this must make it only a matter of time before the world's central banks are forced to raise interest rates to keep inflation under control. The last point that I'd note is that the acute financial difficulties at Evergrande, the world's most indebted property developer, as well as at other Chinese property development companies, have raised questions about the sustainability of China's property and credit-led economic growth model. Any slowing in the Chinese economy must be expected to have spillover effects to the rest of the world economy, considering that China is now the world's second largest economy and the world's largest international commodity consumer. Against this background, I have asked the panelists to focus on the the following 4 questions. I've asked Tobias to answer the question, how do today's excesses in the world's equity, housing, and credit markets compare to the 2006 housing and credit bubble? The question I've posed to Joe Gagnon is, as inflation proves to be longer lasting than expected, the world major central banks appear to be on the cusp of winding down their bond buying programs. How much of a risk does this pose to the world's asset and credit markets? And what is the likelihood of another world economic recession? To Bill White, I've asked the question, over the past 2 decades, we seem to have gone through a number of boom-bust asset price and credit market cycles. What might the central bank's role have been in those cycles? And how might we wean ourselves from these cycles? The last question that I'll take is, how much of a risk do Chinese property market troubles and the very high emerging market debt levels pose to the global economic recovery? So having set out the agenda, without further ado, I'll ask Alex Pollock to start moderating our panel.
Thank you, Desmond. And let me add my welcome to our distinguished panel and to all of you who have joined us today. I thought we might restate our theme in biblical terms as, what hath central banking wrought? Well, central banking hath wrought more than a decade of historically low interest rates, negative real interest rates for long periods, widespread negative nominal interest rates, as Desmond said, vast expansion of central bank balance sheets, including the $8.6 trillion Federal Reserve balance sheet at the moment, plus plenty of monetization of government debt and mortgages. For some years, with all this money printing, people said, but where's the inflation? Since consumer price inflation was only, as they said, only 2% or so. The answer was obvious. The inflation was in asset prices, which have expanded enormously into the everything bubble that Desmond so well described. But now, as we know, the inflation has expanded forcefully into consumer prices, over 6% year over year. But actually, if you measure by the 10 months of 2021 year to date, the annualized inflation rate is 7.5%, and it's getting more public worry and attention and political discussion than in many years. Central banks, as Desmond said, are cutting back or ending their asset purchases. The Federal Reserve belatedly is reducing the rate at which it's increasing its balance sheet. Amazingly, the Fed is still buying tens of billions of dollars in mortgages to continue feeding what's already a runaway house price inflation, as Desmond also mentioned. What next? Will the now emerged consumer price inflation cause actions which cause an end to the asset price inflation? What is the outlook for the everything bubble and its component bubbles, like the Chinese property bubble, which seems to be imploding? What will the future or fate of the everything bubble mean for economic growth and for financial markets and financial systems? Our excellent panel is going to help us figure all this out. Each of the 4 speakers will address a specific question, as Desmond explained. Each will speak for about 10 minutes, which will be followed immediately by a 5-minute discussion of that question. After all 4 questions, we'll have a general discussion of the issues until a prompt adjournment at 11 o'clock. At any time during the conference, listeners can email questions to John Kearns at AEI, john.kearns@aei.org, or Twitter with Ask AEI Econ, Ask AEI Econ. And we look forward to hearing from you. Our panel will start with Tobias, who asked the question, which I'll repeat. How do today's excesses in the world's equity, housing, and credit markets compare to the 2006 housing and credit market bubble? Tobias.
Well, good morning. It's wonderful to be back on this panel and discuss extremely pertinent questions of the moment regarding asset valuations and, of course, the feedback between asset valuations and the macroeconomy. As Alex and Desmond pointed out, I'm going to particularly focus on the comparing and contrasting of today's situation to the pre-2008 situation. So today I brought some slides in order to illustrate what I'm talking about. So I'm going to share my screen now and go through these slides briefly. So monetary policy and the everything asset price bubble. So to set the stage, let me show you visually what Desmond already mentioned, which is that central bank balance sheets increased tremendously through the COVID crisis. So the right chart shows you the change, the month-over-month change in billions of dollars, and on the right axis of the right chart in terms of percent of global GDP for the Federal Reserve, the European Central Bank, the Bank of Japan, and the Bank of England. And you can see that the magnitude of asset purchases is much larger in 2020 than in 2008. And of course, the intended consequence of these asset purchases is to ease financial conditions. So financial conditions are the sort of average funding costs for corporations, households, and the government. And the left chart shows you those financial conditions. So the looser the financial conditions are, the lower credit spreads are, the lower interest rates are. And you can see there very clearly that for the US, the black line, we are at this point looser as to our measure, looser than pre-2008. That's also true for other advanced economies. The euro area is very close to being as loose as in 2007. China is really the only exception here. China is somewhat in the tight spectrum and has been there for many years. So our financial conditions indices here are purely price-based. And so this is basically looking at credit spreads and interest rates and price earnings ratios, etc. So the easing of financial conditions is very apparent, and it's in sharp contrast to the sharp tightening back in March 2020 that is also apparent. So the tightening in 2020 was very sharp and pronounced, but less pronounced than in 2008. And that is partially because the central banks came in so early and so aggressively to ease financial conditions. So asset purchases have the intended consequence of easing financial conditions, but of course, that goes hand in hand with a rise in asset valuations, right? When discount rates decline, when credit spreads decline, when risk premia decline, that means that asset prices can become misaligned. And so the left chart here shows you global equity market price misalignment. So this is essentially estimating dividend discount models that allow for risk premia, that allow for risk, and that take into account expected future earnings. And you can see that for many countries, you do see stretched asset valuations, and the magnitude of those asset valuations is very large. So the easiest way to look at asset valuations in the high yield market is to just look at the high yield spread, which is on the right side. And again, you can see that the high yield spread is, not exactly at the low level before the 2008 crisis, but extremely close to that. Now, default rates remain very low, and what we put in there is a baseline scenario for defaults as of 2020. And the market forecast at that point was that default rates were going to rise. But of course, there was so much fiscal support and borrower support that actual default rates are very low and are projected to be even lower going forward. So, of course, stretched asset valuations are problematic because they typically go hand in hand with risky investments. And there are many ways of gauging financial risk-taking or re-leveraging and financial sector leverage. Here we show you two examples. The left chart shows you the notional amount of over-the-counter equity-linked swaps and forwards. And clearly, all over the world, we are again at record levels here in using this particular indicator of risky investment strategies. Another way to look at that is on the right-hand chart, the CLO issuance. So collateralized loan obligations are one of the only structured credit products that is still alive, and it's alive and well. As you can see, issuance in 2021 is way beyond the pre-2008 crisis levels that used to be the record levels. So leveraged lending is booming, and you can see that in the right-hand chart. And when you look into the structures in particular, what you can see is that the underwriting standards are deteriorating to some extent. So, for example, leverage embedded in the underwriting of leveraged loans is rising. Housing prices is another headache. Of course, housing prices have rallied throughout the crisis. It's a very unusual crisis in that real activity collapsed very sharply due to the pandemic. But at the same time, because financial conditions eased so massively, and because the fiscal support to borrowers was so strong, and the fiscal support for employment and for firms was so strong, that housing prices rallied throughout the crisis. And so in many countries, you have seen new records in housing prices. So, one way to gauge the housing risk is to estimate house prices at risk. So what I'm showing you here is the pre-global financial crisis density for housing prices, as well as the latest estimate. And you can see that, the downside risk, this is where we look at the left percentile of this housing price distribution. It's not quite at the level of the pre-GFC, but it is very close to that. Here we're looking at advanced economies on the left chart and emerging markets. And for emerging markets, actually, the picture looks somewhat worse than pre-GFC. So we do worry about the downside risk to housing markets in emerging markets more today in emerging markets, and more in emerging markets than back in the pre-2008 crisis situation. Now, of course, there's one huge difference, which is that the financial structure underlying the housing market has changed dramatically, right? So the whole shadow banking system from pre-crisis doesn't exist in that form anymore. So the regulatory arbitrage through structured investment vehicles, the SIFs and the conduits, all of that has been dismantled. And so I would argue that the underlying structure of financial intermediation is safer today. So even if we do see a very sharp contraction in housing prices, I would not necessarily expect there to be a financial crisis. And one way to measure that is to look at the global bank stress test. So the left chart shows you a capital shortfall for global banks, and then broken out into advanced economy banks and emerging market banks, basically asking how much capital shortfall would there be under a severe crisis scenario. And that's about 3% capital shortfall. Given the level of capital we have, this is very manageable. Again, in emerging markets, the picture looks much worse. The capital shortfall is about twice as large. And I would also point in the right-hand chart that capital flows to emerging markets are much more volatile. Here I'm showing you the international claims from banks to banks. So what is sort of like the capital flow associated with emerging market lending to other emerging markets, and that's extremely volatile. Finally, this is my last chart.
Okay, 1 minute.
Yes, sorry about that.
Thank you.
This is my very last chart. Of course, Bitcoin was already mentioned. You can see the volatility of crypto assets here. And what is extremely interesting and less well known is that this volatility of crypto assets goes hand in hand with leveraging up and down in crypto asset derivatives, which are shown on the right-hand chart. So risk-taking is an extremely important factor in crypto asset world as well. Sorry for being slightly slow, and I finish here.
Thank you very much, Tobias. Let's go to Joe with the question, as inflation proves, oh, I'm sorry. We're getting your, I'm sorry, I am wrong. We're going to our discussion period. We're going to have 5 minutes of discussion of Tobias' points. Anybody on the panel want to begin? Desmond?
Yeah, a few things. Firstly, thank you, Tobias, for those great slides. That what strikes me is that not only are we getting financial conditions being eased at a time that the bubble is getting bigger and the recovery is getting stronger, but I wonder whether there's also the factor of inflation. That so now what we've got is interest rates are becoming increasingly negative. Two other points. One is, while you're saying that the banking system looks in pretty good shape, I just wonder what your views are about the non-financial banking system. The shadow banks. There's just a huge amount of debt there. This is an unregulated part of the economy. I just wonder whether they're just a whole bunch of long-term capital management kind of crises waiting in the wings with all of this borrowing. The last point is that I just wonder on the question of how does 2006, 2008 compare to today? Might the bubbles today not be more pervasive? That it just seems that in every corner we're seeing bubbles. It's not restricted to one or two markets. And I'm thinking in particular, a huge amount of lending to emerging markets that look in really very poor shape to be having all of this debt.
Yeah, these are excellent questions. Let me start with the inflation. Certainly, the inflation print that was already mentioned this morning, was very large in the US, 6.2%. It was, well beyond expectation. And, when you look at the market applied path of interest rates, it has moved forward tremendously. So longer term interest rates remain very low. So far in the future, real rates remain extremely negative, right? It is somewhat surprising, perhaps. But in the short term, interest rates are much higher. So the yield curve has flattened tremendously. We might well see a liftoff, earlier than was previously expected. Of course, the tapering was already mentioned. It remains to be seen how quickly the liftoff in interest rates is going to be and how far up we are going to get. And that really depends on inflation. Again, the path of inflation has been surprising. There has been more and more supply shocks that were unexpected, both in terms of magnitude and in terms of persistence. And so, we might well be surprised going forward as well. And so absolutely, as monetary policy is tightened, the easing is going to be undone. And we would expect that financial conditions globally are going to tighten, that interest rates are going to go up, that credit spreads are widening, and that could be extremely difficult for highly levered borrowers. I fully agree with the point that emerging markets look somewhat fragile. Total debt to GDP during the crisis has gone up by 15 percentage points. So global debt to GDP went from 85% to 100% on average. And of course, there are some countries that are extremely highly levered. So high interest rates and high credit spreads could be, very difficult for that. Finally, in terms of shadow banking, market-based finance is in need of reforms. The Financial Stability Board is working on that, but there are many dimensions of non-bank finance that need reforms, and hopefully those reform efforts are going to go through smoothly.
Other points or questions for Tobias?
Yes, Tobias.
Bill.
Can I ask two questions? The first one, you said that the banks are less exposed on the mortgage side. there has been a massive transformation in the structure of mortgage financing in the US. Could you say something about the vulnerabilities of the non-banks? And the second question really has to do with the functioning of the US Treasury market. I have been worried about dysfunctioning markets and absence of liquidity in many other markets. But now the US Treasury market seems to be caught up in it. What are your observations on that?
Yeah, let me start with the second question first about the US Treasury market. And, the very, very stark and unexpected development last March. There was a dash for cash. And normally when there is flight to quality, treasuries are rallying, i.e. treasury yields are going down very sharply as there's more and more money flowing into treasuries because treasuries are viewed as the safest asset globally. That was true in the Lehman crisis. Even though the global financial crisis originated in the US, there were massive inflows into US treasuries because of flight to safety into a safe asset. But in March 2020, first yields were declining, and then suddenly yields were starting to increase very sharply in US treasuries. So US treasuries, in some sense, were no longer perceived to be the safe asset. And so, there are at least 4 or 5 elements that are coming together here. One was the unwinding of trades that hedge funds put on. Another one were foreign investors that were unwinding treasuries. Finally, a lot of those market-based financial intermediaries had to generate liquidity. They had huge redemptions, and typically they sell the safest assets first. So, mutual funds alone probably sold over 200 billion of treasuries in the month of March. So a lot of selling and basically less buying than selling, but it is very unusual because it questions the hedging properties of the US treasuries. Normally you think US treasuries are going to go up in crisis, in value, and that is put into question now. So there's a lot of soul searching about how to fix these issues, going to central clearing. The standing facility by the Federal Reserve was already introduced that could be broadened in terms of access in principle. And there are other market structure issues that are under discussion. In terms of your other question, sorry, what was the first question? Now I forget.
The question
non-bank mortgages in the US.
Oh yeah, absolutely. Yes, non-bank lenders have become a lot more important. Over 50% of mortgages are originated by those non-bank lenders. There is a question of whether they stay on those balance sheets. It is certainly true that non-bank lenders are less well regulated than the banks, and there's some exposure to the mortgage market, but some of those that get originated do get sold off. They get securitized by the GSEs, and then they end up on other balance sheets. So these could be non-banks or they could be banks. So yes, there's certainly a risk there, and it's a risk that we worry about.
Okay, thank you very much. Very good discussion of the question. And now we will move to our second question with Joe Gagnon. Joe, as inflation proves to be longer lasting than expected, the world's major central banks appear to be on the cusp of winding down their bond buying programs. How much of a risk does this pose to the world's asset and credit markets? And what's the likelihood of another world economic recession? Joe.
Okay, well, thanks, Alex. Quite a big question. Let me start by claiming a little credit here for something I said a while ago. Just you'll see why it's important. If John would share the slide. Last February, seems like an age ago in terms of inflation anyway, I put out this post on the Peterson website warning of a big surge in inflation. And so with this week's inflation data, I'd like to take a little credit.
Congratulations. You beat the Fed for sure.
Yes. At the time I put this post out, the blue chip consensus of inflation, CPI inflation for the US this year was 2.3%. And the highest forecast across all 50 private forecasters surveyed was 3.2. I was saying it would be at least that, if not more. So I want to take some credit for that. But I think I think it's important because I'm not the claim I'm going to make that I'm not so worried about it isn't isn't to my mind undermined by the fact that we have seen more inflation, because I think it's going to drop fairly sharply, although not as sharply as the Fed thinks next year. I think concerns some have expressed about a return to the inflationary 1970s are misplaced. That happened after many years, 5 or more years, of major Federal Reserve policy mistakes that the Fed's not going to make this time. I think a better analogy, if John will go to slide 2, is the Korean War. And if you look at the red line here, that is inflation in the Korean War. The shaded region is the Korean War, the 1950s. Inflation surged from negative values to 10% in 1951. Very rapid, a bigger surge in inflation than we've seen this year by some magnitude. And yet it fell back all the way to 2% just a year later, and then down to 1% 2 years later, without causing a recession. The recession didn't happen until 3 years later, when the war was over and all the people were demobilized and spending collapsed, and that caused a small recession. But the inflation came and went long before we didn't need a recession to do that. So I think that's a better analogy. I think after 30 years of low inflation in the US, the mindset of Americans is not that of the 1970s, it's more that of the 1950s. But turning to sort of my forecast, I think we'll get more inflation next year than the Fed thinks. The Fed thinks we're going to get about 2.25. Maybe they'll revise that upward. I think it would be more like 3, which is still a considerable drop from this year. But I think that the key thing, and that this is why it's relevant, is I don't think the Fed's going to have to raise interest rates all that much to prevent a recession. I guess you can end the slides now, John, and I'll just thank you. So if you look at Tobias mentioned the Treasury yields, that they did go up after this week's data release. The yields in the 2 to 3 year ahead sector of the Treasury curve went up about 1/4 of a percentage point, and that's noticeable. It's a big move for 1 or 2 days, for 1 day. But if you look at what they imply that the Federal Reserve's policy stance 2 years from now will be 1.5%. The federal funds rate 2 years from now will be 1.5%. That's hardly alarming. Moreover, I actually think that's too optimistic. I actually think, given my inflation forecast, it will be closer to 2 or 2.5%, have Fed funds rate 2.5% 2 years from now, because the Fed is going to have to fight a little bit of this excess inflation, or this inflation that's a bit above target. But I don't think it's a huge deal. I don't think it will cause a recession. We've seen the Fed. It's not true that the Fed has only succeeded in preventing inflation by causing recessions. It has done that sometimes, but that's when it made mistakes. It didn't need to do that in the 50s. It didn't do that in the 90s. I don't think it will do that now. So turning to the sort of what does that mean for going forward and the questions I was asked, I think that the market certainly thinks, and I tend to agree, and as Tobias just mentioned, the market thinks low rates are here to stay decades into the future. The 30-year TIPS yield is still negative. That's just incredible to think. Even if you look at the forward rates, they're very, very low, as far out as you can go. Why is this? Well, people have talked a lot about this, demographics, and if you look at the whole picture, some people have looked at a piece or two of this, and some people think they're going to go further down. Other people think they're going to go back up. I think if you look at the whole picture, the best studies say that we're probably going to stay around where we are at very low rates for at least a decade, maybe more. This is because of low birth rates, because of increasing lifespans, because of the baby boom. The baby boom effects are waning, but those other two effects are continuing. Lifespans continue to grow, birth rates continue to fall. And this is not just in the US or the advanced economies, this is a worldwide phenomenon. And there may be other factors that were contributing a bit, some rising inequality, some change in the nature of technology, some regulatory changes, all contribute, and none of them look likely to reverse. So if you think about asset prices in this kind of world in which real interest rates are zero, as far as the eye can see, then that supports very high asset prices. Asset prices should be higher than they ever have been in history now, because their streams of rents and profits that support those asset prices are being discounted at essentially zero interest rates. And that justifies a fundamental asset price that's very high. I had wanted to ask Tobias, and maybe if in discussion we can get around to this, he had a measure that showed that US equity prices were a little on the high side lately. I'm curious as to how he calculated that and what it would show for the year 2000 when we had the tech bubble. My own favorite measure is the earnings price ratio for a broad equity index minus the 30-year real TIPS yield. That is currently quite positive and only a bit moderately below its historical average. It's nowhere near where it's been during past bubbles. In the year 2000, that measure was negative, which definitely was ringing alarm bells for a bubble, but it is not ringing alarm bells now, as far as I can see. And I think similarly, I would say similar things about housing, for example. Again, rents are still positive and rising, and the mortgage rates are incredibly low. So that should support very high house prices. So the bottom line is, and I'll close here, is that I really don't see big risks emanating from the United States in terms of this inflation and everything bubble. I think the Fed will be able to handle the inflation. We'll get back to where we were. It may take a couple of years. It will be a bit longer than the Fed thinks, but it's not going to require 5, 6, 10% interest rates. It's not going to cause a recession. That's not where we're heading. But just to end, I think, where are the risks coming from? In my view, I would see the risk coming from the rest of the world, not the US and not even the advanced economies mostly, but the emerging markets and maybe cryptocurrencies, as Tobias mentioned. In particular, I think, as Desmond's going to talk about, China real estate certainly has me somewhat concerned, in particular because if the property market in China were to melt down and spending on housing, construction, and related activities were to collapse in China, that could really affect China a lot, of course, but the rest of the world, because it would probably push the renminbi down as people panicked about China and threatened to further blow up China's big current account surplus, which the rest of the world really wouldn't be able to deal with. But I'll leave it to Desmond to talk about those risks. I don't see the US as being currently a big source of risk. Thank you.
Thank you, Joe. Okay, questions or for Joe or points on his comments? Bill.
Yeah, Joe sort of referred to, the 1970s and saying we're not going back there. But I guess my question to him would be, maybe it's an observation. There are so many more supply side shocks to worry about today than there were then. So we've got the energy transition, where we're starting to see this now in spades, okay, transitioning to a green economy. Not to say we shouldn't do it, but we've got that energy price thing in spades. It'll go on for ages. We've got food price shocks. We see that all over the place at the moment. We've got climate change, which is going to be enormously costly, both adaptation and mitigation. We've got all the demographic stuff that you referred to. I'm thinking back Charles Goodhart and Pradha's book about this is going to profoundly slow growth and profoundly raise inflationary pressures. We got deglobalization. Like, we've got so many things out there that will both slow growth and raise prices. How do you see this not being a risky situation, not just in the US, but globally?
Well, there are, I'm not going to deny that there are huge risks always in the world, but I don't see the risks as being so overwhelmingly one-sided as you do. I think they're very balanced. I think, for example, in the Goodhart and Pradhan book, they only look at one piece of the demographic puzzle, and they get a very, in my view, biased conclusion. My colleague at Peterson, Olivier Blanchard, is actually writing a book on what the new world of fiscal policy with low interest rates. And I can't, obviously I've been talking to him about it. What he has told me, and I believe, is that the Goodhart book only looks at one piece of a much bigger picture, and that the other pieces go the other way. And that the more comprehensive looks, because I think one thing that Goodhart does not take account of is lifespans. He focuses a lot on birth rates and the baby boom, but he doesn't look at lifespans. And other people say that actually the raising of lifespans over time is as big, or if not bigger, pushing interest rates down. So that even if there is a reversal that he talks about on part of the story, there's this other piece that's not reversing, and then the two are going to cancel out. So basically the conclusion is we're going to stay with low interest rates for at least another decade, maybe two. And I tend to buy it. But
if the interest rates are low because growth is slow and everybody is overburdened with debt, does that not imply, sort of going back to your R minus G condition, that Houston, we have a problem?
Well, I don't know if you call it a problem. I mean, people want to save because they're seeing longer and longer retirement periods, and they need to save more and more in that world. That's the key point that Goodhart misses. And I don't think that's going to change. So what do we do about it? Well, one answer is that we should have big fiscal deficits and we should run up government debts because the cost is zero. It's a free lunch now. It goes back to the Diamond paper on Social Security systems, how you could have a free lunch if the interest rates are very low. We may be in that world, and that may support the kind of Build Back Better program that Biden's doing. If you spend the money wisely on useful things that have social value, you can make everyone better off, including future generations. And that applies in spades on climate. If we can invest now to mitigate climate change, we will benefit our own economy now through creating these new jobs and infrastructure and supply and capacities, but we'll benefit future generations with a better climate. So it seems to me that the case has never been stronger for big fiscal deficits, especially invested wisely to mitigate climate.
Invested wisely, a big assumption, of course.
Yeah.
Other questions or points for Joe? Desmond?
Yeah, I want to add something to what Bill said, that certainly there are a lot of supply side problems, but surely we shouldn't overlook the magnitude of the demand stimulus that was given. So what we've had fiscal stimulus amounting to 25% of GDP in 2 years. And on top of that, we've got Federal Reserve policy that has never been easier. We've seen money supply growing by 25%, interest rates at ridiculously low levels. And what that's given rise to is a huge amount of excess savings within the economy. So if you now get inflation, that excess savings at risk of being spent, so the notion, to dismiss the idea that we're going to have overheating, strikes me as being a little bit odd. The other point I'd just make is that it would seem to me that a lot of these bubbles are premised on two things. One, they premised on on low interest rates, and the other is rapid growth. Now, you're pointing out certain, you're not acknowledging that the interest rates are going to have to rise a lot, that could burst bubbles. But I would say that, if you get the growth accidents that you're mentioning, that would be another leg that could trigger these bubbles bursting.
Well, actually, Desmond, I think I'm pretty much with you. And, I think I totally buy the point that we overstimulated the economy. The fiscal package was too big. That's exactly right. That's why I predicted a big burst of inflation this year. But going forward, and I think the Fed's, if the Fed had really thought about it carefully, probably they would have started the taper sooner. So yeah, I'm actually with you, Desmond, on all these things. But I think that we're seeing a big fiscal retrenchment now. Even if these packages pass, there's going to be a big reduction in the budget deficit going forward. There is a savings overhang, but if you look at what happened after World War II, that savings overhang wasn't spent very quickly, and this is somewhat similar. So I suspect it will only be a small positive boost to growth. So I think, I think that there will be a lot of forces slowing things down next year. But yet I agree with you. We're going to get more inflation than the Fed thinks. 3% inflation next year is what I'm predicting. That's much more than the private sector forecasters are calling for, or the Fed. So people would put me in your camp. There is inflationary pressure, and the Fed's going to have to raise rates more than it thinks or the market thinks. So I'm with you. I just don't think it's going to be catastrophic. I don't think it's going to be interest rates 1% higher than the market thinks at most. That's what I think, and that will be enough. But I get your concerns. I think I tilt in your direction relative to the consensus. Nevertheless, not as far, perhaps.
Thank you. That could have some interesting asset price reactions, as you point out, when you start raising the discount rates. Good discussion. Thank you. It's time to go on to our
I think
next
Tobias wants to raise a question.
Tobias, when we do this,
Yes, just half a minute. Joe asked about the asset valuation model that I was using compared to So say if you open the most recent Federal Reserve financial stability report that presents the measure that Joe was talking about, that's basically the forward earnings price ratio in excess of a real long-term yield, say the real 10-year treasury yield that can be computed in different ways. The Fed is using the survey of professional forecasters to compute that in order to have a longer history going back than using the 10-year TIPS yield. But in any case, that type of equity risk premium calculation basically shows, that we are long-term average about 4.5% to 5%. There's a related measure by Bob Schiller, which goes back to 1870. So instead of using the forward earnings expectation, he's using the 10-year trailing average earnings, and that has a surprisingly good forecasting power for future realized returns. And that metric of the equity risk premium is at about 3%. So that's also, well within the historical standard. What I'm doing instead is to also control, so it's a more of a regression-based approach. So we are forecasting future equity returns, but we are not only controlling for future earnings or earnings expectations and real yields, we're also looking at forecast dispersion. And so at the moment, it's still the case that forecast dispersion is very large. There's a lot of uncertainty in terms of the real economy going forward. And so it's relative to this forecast dispersion, this real measure of uncertainty in some sense, that you see the stretched asset valuation. So it's an additional input here, which is a measure of real uncertainty.
Thank you. Thank you.
Thank you, Tobias. Yeah, and thanks again, Joe. Let's move to Bill. Over the past 2 decades, we seem to have gone through a number of boom-bust asset price and credit market cycles. What might be the central bank's role in these cycles? How might we wean ourselves from the cycles? Bill.
Thank you, and thanks to Desmond for the invitation to come back again. I think before I get on to the question of how did we get to where we are, and how do we prevent getting here in the future, prevent us from getting here again, one needs to start off by saying where are we? And I would just say, without repeating what Tobias said, and Joe, I think I'm more in Tobias's camp than probably Desmond's than Joe's. And that is to say that I think, because of the Fed's and others' past policies over decades, really, that we are actually in a very dangerous place. I think that we're exposed on a very narrow path, either to deflation and serious depression on the one hand, or potentially high inflation on the other hand. So I think where we are is a place where we don't want to be. So that's my starting point. So you either believe it or you don't. The second question is how did we get here, if that's where we are? Let me say a few words about what the central banks have done to contribute to this, and then go on to the issue of why I think they've done it. On the what, I guess if you look at the pre-GFC, what you see is a whole series of cycles going back to the 1980s, where basically the reaction to any downturn or prospective downturn was easy money. And we saw this over and over again. It started in 1987, then we had it in 1990. We had it in 1995 with the Asian crisis. We had it in 1997 in 1998 with LTCM, then in 2000 and 2001 and 2007. So all through the pre-GFC period, we had this asymmetric application of monetary policy. They always eased more than they tightened. And then, of course, we had the downturn in 2008, and the answer was essentially more of the same. And it started off as a resistance to financial instability, and then for reasons still I don't understand, it morphed into 10 more years of ultra easy monetary policy. And then we had the post-pandemic. And if the previous had been more of the same, then post-pandemic was still more of the same. And then we are where we are. Now, the next question is, why did the central banks do this? I think there's a wonderful line from Keynes that I will repeat. He said, we have gotten into it, this is back in the 1930s, we've gotten into a terrible muddle. We have erred in the operations of a delicate machine, the workings of which we do not understand. And I'll come back to this humility question in a moment. But first of all, why have the central banks done what they've done, mistakenly, in my view? I would make the point that most of what they've done over the course of the last 30 years has been unnecessary, ineffective, and probably harmful. And I say unnecessary because I think for the last 30 years, largely because of China and globalization, we've had a whole series of positive supply side shocks. And positive supply side shocks both raise growth and lower inflation. And they do not require a monetary offset. And there's a whole literature, a vast pre-war literature on these kinds of problems that has been totally forgotten. And my contention would be that we leaned against these positive supply shocks in a way that we should not have done. And this has created problems. The second thing is monetary policy is increasingly ineffective. And it goes back to the debt questions that we've all been talking about. Some of you may remember Alan Greenspan. Alan Greenspan talking about the headwinds. Well, what he was talking about was that as you lower interest rates and you encourage debt and you bring spending forward in time, you basically make it more difficult to do more spending in the future. So there's a fundamental intertemporal problem here that renders monetary policy in the end ineffective. And if you look at the numbers over the previous cycles, you'll see that this is the case. The third thing is, I think what they've done has actually been harmful. And I won't go into all of the issues. Tobias has actually referred to some of them. Over the course of the years, we have built up not just these enormous debts, but all sorts of problems in financial markets, the fruition of which we have yet to see. We have, I think, in addition, probably lowered potential growth through ultra easy monetary policy. The question of all the wasted resources, the Ubers, the subsidized spending, the Evergrandes, the zombie companies, the list goes on and on. So those are sort of the specific flaws that I think have led the central banks to do what they did. But there is a general flaw. And the general flaw is what I refer to, and this goes back to Keynes's problem. Okay? We have a world which is complex and which is adaptive. And all of the models that the central banks use start off with a very opposite assumption. They start off with models that say the world is essentially simple and it is constant and it is therefore understandable and controllable. And my contention is that fundamental assumption is wrong, and it's always been wrong. And instead of sort of starting off with the kind of models that we do have, and that still sort of dominate the policy decisions. We should be starting off by assuming the world is a complex adaptive system. Systems which, by the way, are ubiquitous in both nature and society. And there's huge amounts of scientific literature about how you manage those kinds of systems. And to give you just 4 simple examples, these complex adaptive systems always break down. And the lesson is be prepared. The second thing is maximization is beyond our powers. Okay, policy, the lesson is policy should be directed towards ensuring really bad things don't happen. The third thing is anything can trigger a crisis in a systemically unstable system. And the answer is focus on the stress lines, forget about the trigger. And the fourth lesson, complex adaptive systems, because they're adaptive, are always changing. Be prepared for the unexpected. And the problem is the central banks haven't learned any of those lessons. And we shouldn't be surprised that we find ourselves in the situation that we're in. Well, how do we move forward? We are where we are. Or in language of complex adaptive systems, okay, we are path dependent. We always start off from where we are. Well, we are where we are. And we have this huge debt overhang, and we have all of these imbalances. So when Desmond asked me, how do we tweak the system? Desmond, with all respect, the system can't be tweaked. We are where we are, and these problems have got to be, these financial problems that Tobias is wrestling with, have got to be dealt with. And I don't have much time, so I'll just say, I think the principal way in which that would have to happen is we need much more thinking about debt restructuring, private debt restructuring, household, corporate, bank, non-bank, and above all, sovereigns, where there are not even any agreed principles on how this restructuring should be done. So there's a huge amount of work to be done there. Well, let's suppose those problems are out of the way, and you didn't have these problems from where we are. What would you do differently to make sure that we don't repeat what we've just gone through or what we're going through? I think there's a whole list going from some simpler things to more complicated things. And I'd start off by saying, as I've been saying, Joe went back to his paper. I'll go back to my stuff 20 years ago at the BIS, which is we need a macro financial stabilization structure that leans against the financial cycle. The financial cycle is the problem. Pro-cyclicality, people getting carried away. It is no longer the business cycle. It's the financial cycle. That's where the action is. And we need both macro policies and macro prudential policies to lean against it. If you can't do that, we need to change people's behavior. And the way you do that is by sending bankers to prison, like they did after the S&L crisis, as opposed to simply fining the banks for bad behavior, fining the shareholders for the mistakes of the management. Need to change behavior. We could change structure. That's another thing we know about complex adaptive systems, that you can change the structure of the system to make the system both more stable and more resilient. We could do that. We could roll back globalization. We could roll back consolidation. We could roll back securitization. All of these things are possible.
You're down into your last, Bill. You're in your last minute here.
I'll finish with this. If we can't do that, we should raise capital requirements very significantly going forward. If we don't know enough, we just simply raise capital requirements. 30 seconds. Central bank digital currency. I'm not sure whether people have been talking about this very much. Central bank digital currency, which opens up the opportunity for everybody to own central bank money. This is an open doorway to narrow money that the guys in the 1930s, Irving Fisher and the Chicago School suggested. So if people had the courage, we could move to a totally different world. And it would be a world in which inflation would be under control, the financial cycle would be moderated, signage would be taken away from the commercial banks and given back to the governments and the central banks where it belongs. And if all of this sounds too good to be true, that's probably why it's not going to happen.
Thank you, Bill, for very provocative comments. as always. I want to just quickly make two remarks. One is you mentioned the need for a debt reorganization. I guess that's what high inflation is one form of debt reorganization through depreciation of the debt. The second is I fully agree with your philosophical point there, having been in my arguably misspent youth a student of philosophy, in the characterization of the nature of the reality we're dealing with. But that leads me to a point on the Keynes quote. The mistake in the Keynes quote is to call economic and financial things a machine. They're not a machine.
No, that's true.
And they can't be modeled as a machine.
Yeah.
Anyway, with that, let me open it to the panel. Points or questions for Bill? Desmond? Desmond.
I guess two questions I've got for Bill. Firstly, I've got to really thank him for such a thoughtful analysis of where we are. And my question really is in relation to your idea that a lot of debt needs to be restructured. What would the implication be for the financial system that is holding that debt? Do we need to restructure them as well? Or, how is this going to work? That the government would really need to be involved in a big way if we're writing down a lot of debt. My second point is, while I agree with you about your analysis of how the central banks have been behaving, but might something also be involved, that central banks are focused, that there's an incentive problem. They focus very much on the short term and the longer term is somebody else's problem. That what I'm seeing right now is you really want to get the economy growing. You really want to get the inflation up to the 2%, but you don't really worry too much about the asset bubbles that you're creating down the road. That'll be somebody else to clean up.
Well, spot on, Desmond. In terms of the debt write-down, let me go back to something Alex said about that. Debt write-downs, I think, are absolutely essential. And if you listen to some of the stuff that Ken Rogoff and Carmen Reinhardt, and Carmen in particular, they don't see any way of getting out of this without a significant amount of debt write-down. Who's going to get affected? The answer is everybody. And this is totally different from, people talk about the debt jubilee back under the Sumerians. Well, the difference then was it was the king and a few cronies that took the hit, and they could take the hit. And today, of course, the debt is widespread. It's in the banks, it's in the pension funds. Nobody is going to thank us for debt restructuring because everybody's going to have to pay the price. It may well be in many instances, banking systems will have to be restructured. And if that happens, then the government, of course, will have to be there as the system supporter of last resort. And it's the fact that the difficulties that we face in debt structuring are so great that nobody wants to face up to it. It is politically unpopular. And that, of course, gets you back to your second point, which is the central banks being focused on the short term. And they have been. And the whole point is that every cycle, they do what they do, and viewed from a one cycle perspective, it's the right thing to do, right? It's the right thing to do. But viewed from a multi-cycle perspective, I'm going back to my, Alan Greenspan's headwinds, it's the wrong thing to do. You're on a wrong path. But the point is that in single period models, or what are essentially single period models, the path never comes into it. So in central banks, in support of central banks, what I would say is that it's not just the central bankers that are too short term, it's everybody. And I think even on the fiscal side, Jean-Paul Juncker got off a wonderful line a couple of years ago in Europe, when he said, of course we know what to do as politicians. Of course we know what to do. What we don't know is how to get reelected after we do it. So in terms of that problem, and I'll go back to philosophy again, it's a problem of our nature, this short-termism that we have to overcome. And obviously it's not going to be easy.
Great. That's a great line from Mr. Juncker. That's great. Another question for Bill.
I had a short comment.
Yeah.
Sure. I don't think it's a question, but I was smiling when I heard Bill because he and I share two observations about the world that he discussed that we draw polar opposite conclusions from. So sort of just wanted to point that out. We both agree that central banks have models that are too simplistic, too linear, and have too much faith. They have too much faith in these simple models and not recognize how flawed they might be. And that central banks have tended to cut rates a lot more and quickly and by more than they raise them later. But we draw completely different, so we see both of those things, but we draw completely different conclusions. I would just point out that if you buy the story about demographics that I mentioned, you would expect the real interest rate to have been falling a lot secularly over the past 30, 50 years. And central banks didn't see that in real time, and they were always too little too late, not catching up to the fall in real interest rates and being too tight. And in my view, when you combine that with a nonlinear version of the Phillips curve that Keynes believed in, you would conclude that we've been below potential continuously across the advanced economies for 30 years.
Bill, a final comment?
Well, personally, I find this whole sort of use of the natural rate, which is the intersection of the investment curve and the savings curve, as totally pre-Keynesian. It's like the last 60, no, what would that be, 70, 100 years didn't happen. And if you look at a kind of Keynesian model, basically what it tells you is that the interest rates are what the central bank sets them at. And I think it's been very interesting to see this recent paper by Jeremy Rudd, for example, out of the Fed, which is starting to question some of the, out of the Fed itself, which is starting to question some of the fundamental assumptions on which their monetary policies have thus far been conducted. So I hope there's going to be more of this internal reflection at the Fed.
Bill, you don't see that central bank's job is to set the rates where they need to be to get to the pre-Keynesian neutral rate view? I mean, I sort of buy the VIXEL idea. Central bank's job is to get us to VIXEL's equilibrium.
I do, but the problem, Joe, is that behind the Keynesian model, this goes back to Mises and Hayek and all the rest of it, there's the whole financial sector, which is totally ignored. I mean, if you think about even the Keynesian model that I've described, all of the intricacies of the financial sector, which are now so central and so dangerous, is totally ignored. And I think the central point that I've been making here and others have been making is that if you focus if you focus solely on the real economy and you miss all of this financial stuff, I think increasingly you're missing the forest for the trees.
Let's, at this point, thinking of something dangerous, let's go on to Desmond and the Chinese real estate bubble and other emerging market issues. Desmond, you have the question, how much of a risk do China's property market troubles and the very high emerging market debt levels pose to the global economic recovery?
If I just ask John to put up the slides. Okay, if we just advance them a little. Okay, what I've already said is that the basic premise of the bubbles is, not simply that interest rates will stay low forever or that the central banks will keep buying the bonds, but it was that the global economy would stay very strong. And it's here, that I think China comes into play, as we'll see from the next slide, that China basically is hugely important in the global economy right now. So if something really goes wrong with China, that is going to have spillover effects to the rest of the world. So we see from the next slide, for instance, that the size of the Chinese economy right now, it's the second largest economy, something like 16% of the globe. And what it might not have direct financial linkages to the rest of the world, they're the indirect linkages, what this means for the emerging market economies. They're huge consumers of international commodities. So if China slows, that can have real consequences for emerging markets, can have real consequences for Germany, for Australia, the Asian partners. So it's hugely important where China is going. So if we look at the next slide, we see that what we've already got is we've got China's economy has been slowing, and we used to be growing at something like 8%. Latest numbers show we're growing more towards 4%. And the risk, of course, is that this is going to get a lot worse. Now, there are two real risks. If we go to the next slide, we see that the economy is hugely dependent on the property sector. So if we look at the next slide, we see that the share of the property market in China, this is estimates by Rogoff, that the Chinese property market now accounts for 30% of the Chinese economy. So you know that there's something wrong, because if you look, for instance, at the US, you're talking about something that's the black line, that is something like half the size. So the property market in China has really become far too large. It's been encouraged to do that. And if we go to the next slide, we see that there are real problems, in terms of, if you think that there's been a bubble in the United States, just take a look at the Chinese property prices. The four first charts lines here show that in Beijing, Shanghai, Hong Kong, Shenzhen, we're seeing property prices have got to 40 times the incomes of those cities. You compare that to New York, or you compare that to London, we're talking about something that is 3 times as high. So it's clear that there's a real problem in that sector. If we go to the next slide, the same sort of thing, if just move one slide further, we see that the vacancy rates in China are pretty high, which would be an indication of a fair amount of speculative activity. There's supposed to be something like 65 million unused, unoccupied dwellings. Now, this is the one part of China that is really at risk, that you've got this huge property bubble. But if we look at the next slide, we see that we've got a credit bubble as well. Let's go to the next slide, please. What we've seen over the past is that China has really just pumped a huge amount of credit into that economy, that the ratios now, the overall credit in the Chinese economy is over 300% of GDP, but really where the action is in the non-financial corporates and households. You're just seeing that exploding. If we go to the next slide, just putting that in proportion, and this is something that the BIS has pointed out, and I think that it has to be of concern. This slide is comparing, the red line is the Chinese credit bubble right now, and as I say, we've gone from, it's increased by about 100% of GDP in the space of less than a decade. If we compare that to, what happened in the United States, that would be the blue line. We see the housing bubble, the credit expansion was nothing like what we've seen in China. And we've got the same thing, if you compare to Japan, the Japanese bubble in the 80s, it was a lot less pronounced in terms of credit growth. So the basic point I'm making is that not only do we have a property bubble, but we've got a credit market bubble that is very big, and these generally don't end well. If we go to the next slide, what we're seeing already is that we've got problems at Evergrande. It's indicating that a lot of the Chinese property development companies are in trouble. The Chinese government is recognizing it's trying to deal with this to certainly not make this problem worse by pumping more credit into the system. So it looks like the bubbles are beginning to deflate. And it would seem that this is not going to be at all easy, because it's occurring in a context where other things are going on in China, where the President Xi is following this common prosperity program. Looks like it's reversing a lot of Deng Xiaoping's earlier reforms that laid the basis for the Chinese miracle. We've spoken about China's labor force is declining, so that is not good. Got trade relations with the United States are problematical. So you've got bubbles that look like they're going to be deflating in a context that's not really very good. If we go to the next slide, we see that, I'd argue that China, while it's got these massive property bubbles, I don't expect that this is going to lead to a situation like we got in the United States. It would seem to me that the Chinese have got far too much control over their banking sector to allow the bubble to burst in that violent a way. I think that what we're more likely to see is China go the way that Japan went, from very rapid growth to a prolonged period of very slow growth. So my anticipation is that we're going to see China having a lost economic decade. If we go to the next slide, that the concern about China going to a very much slower growth path is really problematic from the point of view of the emerging market economies. That what has occurred, I think that Tobias mentioned earlier, that the debt levels run up, during this COVID crisis in the emerging markets is huge. So just looking at the next slide, we see that the debt to GDP ratios in these economies are at really so much higher levels. It looks like it's 30 percentage points higher than it was in 2009. So they can ill afford to suffer from a Chinese economic growth slowdown or an increase in the interest rates in the United States. So, I see this as really having the potential, the credit and property bubble bursting in the China, having these effects through the emerging markets, and that can really be really a big issue. Just the last slide that we look at is that the emerging markets seem to me to be in real trouble here, in that they've got huge, quite a number of them. And I'm particularly concerned about an economy like Brazil, which is the largest Latin American economy. It's got huge financing needs that the government has running very large budget deficits, but more importantly, that the debt has become very short. So if we get rise of interest rates, the emerging markets could be very exposed. So I think that one really has to keep one's eye, both on what's occurring in China, what's occurring in emerging markets, because those can have very big implications for the advanced economies, particularly where their asset prices currently are. So that's really what I've got to say about China.
Thank you, Desmond. Questions or points on Desmond's presentation? Tobias?
Yeah, happy to come in. So I just wanted to amplify or complement some points and then ask some questions. So, we have seen the property developers that were mentioned by Desmond in crisis. So Evergrande in particular was mentioned. And of course, there is some regulatory crackdown on the leverage in that sector. Now, for the moment, we don't see broader contagion to other corporate markets within China. So, spreads to other high yield issuers. So in the property markets, there has been quite a bit of adjustment, but in the broader corporate bond market, which is very large in China, there hasn't been as much contagion so far. And I think that is because domestic investors basically expect that the government is going to address the issues. As Desmond showed, while total debt to GDP is extremely high in China, government debt to GDP, central government debt to GDP remains manageable and could be scaled up. And I think there is an expectation built in here that the central government is going to do whatever it takes in order to keep this contained. Having said that, that might be a baseline, but I think there are a lot of risks around that. And the first one is that a lot of this property developer debt enters into the Chinese wealth management products. They're about 100% of GDP in size, so they're very large, and they're not guaranteed. And so there could be a confidence shock in that segment. We haven't seen that, but it is possible. Secondly, as Desmond mentioned, growth rates in China are coming down gradually, and that could put further pressure on the property developer sector. And finally, when you look at the offshore pricing of the sector, there's a lot more nervousness. And I think what people note is that, a number of those developers are under tremendous pressure. And, this fundamental question of how much housing is needed, what are the valuations of housing? I think those are exactly the questions that we are struggling with as well. The one question I would have for Desmond is, how do you see the growth rates going forward interact with these vulnerabilities in the financial sector and in the housing sector? So how is it going to be unwound in your expectation?
I think, I'd agree very much with you that, if you do get a slowdown in the Chinese economy, that is really going to be highly problematical for all of this leverage that you've got in the property sector. It's also got a problem in the housing market. So I would see this as interacting, and, that is going to require a huge amount of government intervention to make it smooth. But I don't see how we avoid China slowing at a big pace. And I think that can be very problematical, because China was responsible for the super commodity cycle. If China now slows, and they move to a different kind of growth model, that can have huge implications. Not least for advanced economies that are exporting a lot of industrial equipment to China. So I think that we've really got a problem.
Any other points on China and emerging markets? Bill.
Yeah, I'm not sure whether this is directed to Desmond or to Tobias, but there was something in the paper this morning, for example, that the rates on dollar-denominated Chinese junk corporate bonds, I think they were at 25% yesterday. They're at 29% today. And the question at issue is, what happens if these people can't roll over money at all? And the subsidiary question, it isn't just a question of the people that are borrowing money in dollars. It's the people that are lending money in dollars that are themselves borrowing the dollars. It's like in Europe. You remember the problem at the beginning of the great financial crisis. The difficulty was that the European banks couldn't get the dollars that they needed to support the longer run dollar investments that they had in the US. Well, what are the problems associated with the funding problems of emerging market corporates, funding problems in dollars? Any observations on that?
Before you get a real answer to your question, I'll just point out that's what proved the Fed is the central bank to the world, not just to the United States.
Yeah.
Desmond or Tobias, comment on Bill's question.
Yeah, I'm happy to give some thoughts. So first of all, I would note that the original sin has been declining. So hard currency debt in emerging markets as a fraction of total debt has been declining quite dramatically. Many emerging markets have developed domestic bond markets in order to fund. Having said that, in this crisis, it was very unusual in that emerging markets were able to access hard currency funding markets, but the domestic markets saw much less capital inflows. China here is the exception. China has been able to sell domestic currency debt and equity to foreign investors, right? And this is the well-publicized index inclusions of China that play a big role here. But for the rest of the emerging market world, basically, domestic debt has ended up on bank balance sheets. So there's a sovereign bank nexus in emerging markets that has become a lot more severe. And I think that hasn't come up yet in the discussion, but I would just flag that, if you have a sovereign emerging market crisis, there's also the exposure of the banks to the sovereign sector in the emerging markets, which is quite severe and very worrisome. And so when I showed these pictures of the drawdowns of capital of emerging market banks, that the sovereign exposure here plays an important role, and is certainly something that we're going to look at much more closely going forward.
Desmond, final comment on the China questions?
I just wonder, with the interest rate spike that Bill is pointing out, whether that might not be reflective of the way in which investors expect the Chinese to deal with Evergrande. In other words, what they'll be doing is allowing Evergrande to default on foreign creditors and just make the domestic creditors whole. So I just wonder whether that is not what's going on in that dollar market, that the investors are correctly assuming that Evergrande won't be allowed to completely implode and take the whole Chinese property market with it. But what they'll do is they'll do it by differentiating between creditors.
Yeah, good point. Let me, at this point, move to an audience question, and we're getting near the end of our time. We might run a couple minutes over time, but we do have a question, Joe, for you from the audience, and it is this: you seem to be presuming that the real growth path will be higher than the real interest rate path when you assert that low real rates justify high asset values. Why do you think real interest rate growth path will diverge from real growth for a sustained period of time? That's the audience question, Joe, for you.
Yeah, sure. Well, that's actually the topic of a book my colleague is writing. So I urge people to look for that when it comes out, maybe next year. If you look at historical data, it is amazing to see that first of all, that there has been a secular decline in interest rates, although there are breaks in that decline at times. But there has been a secular decline going back thousands of years, even going back 100 years. But that government yields in local currency are typically below growth rates, and that is the normal. And it kind of violates what we were taught in economics, that shouldn't be, because in that world there's too much capital. So I don't want to get into the details of all that, but it partly reflects a risk versus safety. It is true that capital has a higher yield than the growth rate. In real terms, capital is profitable, but it's risky. And people want something that's safe, and so they drive that rate down below the growth rate.
Thank you. And thanks to the audience for the question. We are near the end, but I do want to give everybody a chance for a parting shot of a minute or two at the very most. So let's just go through the panel for any final comments in the same order we spoke. Tobias, final thoughts.
Yeah, I do think that the secular decline in real rates is very striking. And, my preferred measure are five-year forward real rates. They have been coming down throughout this crisis, throughout the 2008 crisis. And even as, banking capital globally has been nearly doubled, if not more, if you also count bail-inable debt in that. That hasn't made any difference to the decline in real yields. So I think it is a very stark, stylized fact that deeply impacts monetary policy as well as risk-taking and asset valuations. Let me just make that one point. I think it jives with a lot of what we discussed.
Thank you, Joe. Final thought on over the whole discussion?
I guess I would say that I remain somewhat optimistic about the prospects for advanced economies. Of course, there are always risks, but I think the Fed can handle this inflation burst even if it's behind the curve. It will catch up. I think I'm more worried about emerging markets in China, and I welcome the discussion there because I think Desmond, and others are pointing out the right things. So I'm not an expert there, so I'll just say I enjoyed hearing from them about those risks.
Thank you. Bill, final thoughts.
Well, I would say that I'm worried about everything. The final wrinkle in all of this, of course, is that monetary policy has been used almost exclusively to lean against downturns for ages and ages. Nevertheless, fiscal policy has been, we know the debts have been sort of getting higher and higher, generally speaking. And now, of course, we're actively using fiscal policy. And I guess one of the worries that I would have going forward, and it's certainly not imminent, but is that some combination of continued easy money and recourse to central banks, together with worries about government and fiscal dominance, will eventually lead you into a situation where people decide to take their money and run. And we may, in fact, be starting to see the beginnings of that, both in Bitcoin and the exotics and house prices and whatever. So I think there are some worrisome signs on the horizon. Not today, not tomorrow, but I think we have to keep an eye on this. That's a new thing, this fiscal possibility of fiscal dominance in advanced market economies.
Thank you, Bill. And Desmond, you get the final word of this excellent panel.
Well, I'm very much in Bill's camp, that I think that there are just so many risks out there. I don't think that I've seen quite as many risks in so many places on this kind of scale before. So where that leaves me is I'm concerned about inflation short run, but I think that central banks are going to have to slam on the brakes. When they do, we're really going to see these bubbles unravel, and then inflation is going to be the last thing on our mind. We're going to be worried once again. We'll go through the cycle of having to pump this thing up again to prevent deflation.
Thank you. So to all the members of the audience, thank you for being with us, and to the panel, thank you all for a very knowledgeable, very interesting discussion. Thank you.
Thanks all. Thank you.
Thank you.